This portfolio of 3 dividend stocks will pay your rent. Ever felt like there was nothing left out of your paycheck after paying rent and covering some other expenses? Now, what if we told you that a simple $10,000 investment could one day turn into passive income of $3,000 per month, enough to cover your rent, or even ensure you don't have to pay rent anymore? Sounds too good to be true, right? With the power of dividends and compounding, it's completely possible. In this video, we are breaking down 3 powerhouse dividend stocks. Individually, they are strong, reliable companies, but when combined into a single portfolio, they create a wealth-building machine. By the end, we will show you step by step how this portfolio can turn a modest $10,000 investment into $3,000 per month in passive income. Ready for this game-changing secret? Let's jump in. PG. What better place to start than Procter Gamble, a company that's been a household name for generations. Founded in 1837, PG has built a vast portfolio of trusted brands like Tide, Pampers, Gillette, and Crest, making it a dominant force in the consumer goods industry. The company's top revenue contributors, Tide, Pampers, and Head & Shoulders, are household staples, reinforcing its position as a consumer defensive giant. No matter the economy, people still need detergent, diapers, and personal care products. Geographically, the US leads with about 52% of total sales, followed by Europe at 22% and Greater China at 7%. With its diverse portfolio and global reach, P&G thrives on consistent demand, making it a resilient investment in any market condition. However, investing in PG isn't without risk. While the company enjoys global reach, it faces competition with giants like Unilever, Johnson & Johnson, and private label brands are constantly fighting for market share. P&G must continuously innovate and defend its pricing power to stay ahead in this crowded space. Recently, PG reported a 2% increase in net sales for the fiscal second quarter of 2025, reaching $21.88 billion and slightly surpassing analysts' expectations. This growth was no doubt driven by innovative product launches across various price points, appealing to a broad spectrum of consumers. In terms of stock performance, PG has shown steady growth over the long term, despite occasional market pullbacks. In 2024, the stock delivered solid returns, reflecting its strong fundamentals and resilience as a consumer staples giant. PG is the kind of stock that makes dividend investors smile. With a solid dividend yield of 2.47%, it provides a steady stream of passive income, making it a reliable choice for long-term portfolios. But what really sets PG apart is its consistent dividend growth, averaging nearly 7% per year. That means not only are investors getting paid, but their payouts are increasing at a pace that outstrips inflation. And let's not forget about the stock's growth potential. Analysts project PG to deliver an annual price return of about 10.83%, meaning it's not just a steady dividend payer, it's also a stock that can grow your wealth over time. P&G's strong brand portfolio and consistent demand make it a solid bet for both income and long-term growth. If you like the sound of PG for the stability it offers, you would definitely like the next pick in our portfolio. J&J. There's no denying that Johnson & Johnson is a titan in the healthcare industry, with a rich history dating back to 1886. Over the years, it has evolved into a powerhouse with 2 main divisions driving its success: innovative medicine and medtech. The innovative medicine division is where J&J flexes its pharmaceutical strength, developing treatments across various key areas. Stelara, its blockbuster drug for Crohn's disease and psoriasis, has been a major revenue driver for years. Darzalex, a treatment for multiple myeloma, has also seen rapid growth, surpassing $10 billion in annual sales. These drugs, along with a deep pipeline of new treatments, keep J&J at the forefront of medical innovation. On the medtech side, J&J is just as dominant. If you've ever had a CT scan, an abdominal ultrasound, or even knee replacement surgery, chances are you've encountered a J&J product. This segment covers a vast range of medical devices used in surgery, orthopedics, cardiovascular procedures, and even vision care. However, even giants face challenges. One significant risk for J&J is the impending patent expiration of its blockbuster Stelara. To mitigate these risks, J&J is expanding its pharmaceutical pipeline with new drug developments and strategic acquisitions. It is clear that these efforts are aimed at managing financial exposure while focusing on long-term growth. In 2024, Johnson & Johnson demonstrated robust financial performance, with reported sales reaching $88.8 billion. This growth marked by a 4.3% increase from the previous year, and it was primarily driven by the company's innovative medicine and medtech segments. Net earnings for the year were about $14 billion, which also reflected a 5.6% rise compared to 2023. But looking at J&J's stock performance in 2024, the movement was relatively flat, with a slight decline of 0.20%. While it hasn't been a breakout year for the stock, its massive market capitalization of around $376 billion highlights its stability as a healthcare giant. For investors, J&J still continues to be a compelling option, especially given its consistent dividend yield of 3.18%. Aside its attractive dividend yield, it is also guaranteed that the payout keeps growing, with dividends increasing by an average of 4.2% per year. And while its share price doesn't deliver explosive gains, analysts maintain a positive outlook, with an average buy rating and a 12-month return target of 8.72%. This suggests a potential upside. It is this combination of reliable income and long-term appreciation that makes J&J a classic choice for dividend investors looking for both stability and growth. Still think that $3,000 a month is unattainable? The last piece of our portfolio will surely convince you. AbbVie. Established in 2013 as a spin-off from Abbott Laboratories, AbbVie is a prominent player in the biopharmaceutical industry. Since its inception, it has made significant strides with its focus on developing advanced therapies for complex diseases. One of its flagship products is Humira, a widely used treatment for autoimmune conditions like rheumatoid arthritis and Crohn's disease. Beyond Humira, AbbVie's portfolio includes innovative drugs such as Skyrizi and Rinvoq, targeting various inflammatory diseases, and Imbruvica, which addresses certain types of blood cancers. However, the pharmaceutical landscape is not without challenges. A significant concern for AbbVie is the recent patent expiration of Humira, which has opened the door to biosimilar competition, potentially impacting the company's revenue. To mitigate this, AbbVie has been investing heavily in its pipeline, focusing on new drug development and strategic acquisitions. One of these is Teliso-V for non-small cell lung cancer. This move aims to diversify revenue streams and reduce dependence on any single product. Financially, AbbVie has demonstrated resilience. In 2024, the company reported revenues of $56.33 billion, marking a 3.71% increase from the previous year. However, net earnings saw a decline of 12.07%, totaling $4.24 billion, highlighting the financial pressures of increased competition and substantial investments in research and development. On the stock market front, over 2024, the stock has appreciated by 17.31%, bringing the company's market capitalization to approximately $340.48 billion. This upward trend indicates investor confidence, likely bolstered by AbbVie's proactive strategies to navigate upcoming patent expirations and its commitment to innovation. For dividend-focused investors, AbbVie offers an attractive proposition. AbbVie is the kind of stock that keeps dividend investors happy. With a strong 3.40% yield, it delivers a solid stream of income, and it doesn't stop there. The company has been growing its dividend at a steady 5.28% per year, rewarding shareholders with increasing payouts over time. On top of that, the stock itself has been a solid performer, delivering an annual return of 9.25%. It's the perfect blend of income and growth. While PG, J&J, and AbbVie are all dividend powerhouses, They each dominate completely different spaces. PG is the steady, consumer-focused giant. No matter what's happening in the economy, people still need these essentials. J&J, on the other hand, is a healthcare beast. It's got a mix of pharmaceuticals, medical devices, and consumer health products, making it one of the most diversified names in the industry. And then there's AbbVie. While it's more focused on innovation and drug development, that also means bigger growth potential. 3 companies, 3 different approaches, but all built to reward investors over the long haul. These 3 dividend giants may be great individually, but together they create a portfolio built for long-term wealth. AbbVie leads the way in passive income with its strong dividend yield, helping push the portfolio to a solid 3.02% overall. Meanwhile, Johnson & Johnson adds stability, balancing pharma innovation with steady cash flow, which helps fuel the portfolio's 5.49% annual dividend growth. And Procter & Gamble? That's the compounding machine. Its strong brand dominance and pricing power drive long-term stock appreciation, contributing to the portfolio's impressive 9.6% projected annual return. Let's see the return projection. Imagine starting with just $10,000 in a mix of Procter & Gamble, Johnson & Johnson, and AbbVie. After 5 years, your yearly dividend income grows to $560, and your portfolio climbs to $18,000. Not bad for doing nothing but letting your money work for you. Fast forward 20 years, and things get much more exciting. Now your dividends are paying you over $6,000 per year, over $500 every month, and your original investment has grown to an impressive $131,000. That's real money, the kind that can make a difference in your lifestyle. Now, let's talk about the 30-year mark, where the magic of compounding really takes off. Your portfolio skyrockets to $580,000, and your yearly dividend income hits $36,000, which is about $3,000 per month. Imagine waking up every month knowing your rent is covered without touching your paycheck. That's the power of dividends. No extra effort, no side hustle, just smart investing and time doing the heavy lifting. A portfolio like this, mixing the stability of Procter & Gamble, the resilience of Johnson & Johnson, and the growth potential of AbbVie, shows just how powerful steady investing can be, even with a modest starting amount. This isn't about getting rich overnight. It's about setting yourself up for financial freedom. Ready to kickstart your investment journey? Do share your thoughts in the comments. Like, share, and subscribe to the channel if you haven't already, and hit the notification bell so you don't miss out on future tips.